Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Madan Sabnavis, Chief Economist at Care Ratings, joining in. Madan, welcome to the show. Clearly, yesterday, what the RBI did, they've not really, cut rates. They've maintained their status quo as well. However, they've shifted to state-based guidance, which is clearly indicating that probably rates will remain lower for longer. What do you make of the entire scenario?
I think you're right. I think what the RBI has focused on more is on maintaining liquidity and ensuring that the market bond yields remain stable. So there is a preconceived notion, I would tend to believe, that we want to bring the yields down so that the government is able to borrow at a lower cost. Though overtly, I think the RBI has clarified it's not a case of taking any kind of view on whether it should be high or low, but all the measures on liquidity like the GSPA or the 3VR, V3R, which they're talking of, is more in terms of ensuring there's less volatility in the bond market. So probably we'll have to give the benefit of doubt to the RBI that it's more to make sure that the rates remain stable rather than drive them downwards. But I think that the measures which they are talking of today will definitely drive the bond yields lower. Maybe the 10-year may not go below 6%, but it will remain in the region of 6.1%.
Right. So, do you think maintaining a status quo and an accommodative stance was pretty much on the expected lines?
Was an expected lines. Now, whether it is the right thing or not, I think only time will tell. When I say right thing is that we do expect inflation to move up. I think if you look at the RBI's guidance on inflation, we do expect inflation to remain above 5%. I think their forecasts say, except for one quarter, where it'll come less than 5%, but otherwise we're talking of something in the region of 5%. So ideally at 5%, there should be a tendency for the repo rate to move in the upward directions and not a status quo. But I think the RBI is focusing more on growth, because the way I think in the press conference, the RBI governor made it clear that they look at inflation as being something transient. If you're having high inflation today, it's more because of the pandemic induced effects and not because of inherently inflation being high. And therefore, it makes sense to concentrate on more on growth and ensure that growth becomes stable, because even the 10.5% is something which is more of a statistical number. It may not really coincide with conditions which we see when we see high levels of growth. So therefore, I think the RBI has decided that we'll provide the accommodative stance until such time that growth really became sustainable, and hoping that inflation, of course, doesn't shoot up during this period of time.
Right. Madan, as you mentioned about inflation as well, clearly the monetary policy has continued to remain growth centric. However, there is that underlying upside risk to inflation. Now, do you think that the inflation today is short term in nature? However, they're just looking at protecting long term sustainability, and that's why it's absolutely fine the way it is.
I think the RBI is definitely looking at long-term sustainability, because I think the inflation today is not really short-term in nature. Because if you look at core inflation, let's just look at core inflation, which is what is remains where it is. Because food inflation can go up and down, prices of onions could go up, and food inflation goes up. We have a good onion crop, and food inflation comes down. So let's look at the core inflation part. I think most of the core inflation components work on the basis of MRP. Now, when I say that MRP of toothpaste has gone up, the MRP of detergents has gone up, but these are the prices which are never going to come down again. So onion prices can come down from 80 rupees to 40 rupees or 20 rupees. But once my toothpaste becomes 120 rupees for a particular size, it's not going to come down in future. So therefore, I think core inflation is something which is more or less fixed. Maybe if I take out the crude oil related things, could still be moving up and down. But the pure core inflation, which also excludes the fuel products, to my mind is something which will not really ever move downwards. It's only going to go move in the upward direction. And we've seen that for several services which come under the core inflation, I think the producers have actually jacked up the prices because they're not able to operate at full levels of capacity. And given the current lockdowns which we're having in a number of states, there will be a tendency for this particular component to also move up.
Right. And Madan, with regards to the GDP growth projections as well, they've maintained it at 10.5% for FY22. And this is despite seeing that a lot of global, countries are giving out large stimulus packages. Do you think there could be a potential impact on global growth as well?
In terms of global growth, I think we are still not sure as to what will be the responses of different governments and central banks. Maybe central banks, we do have there's some signals given by the ECB, given by the Federal Reserve, the Bank of England. But in terms of government response, I think it's something which we'll be looking forward to because when we're talking in terms of the second or the third wave of the virus in the European countries, probably not in the US right now, there will definitely be pressure on growth. There will have to be certain support provided by the governments. And therefore, we could be expecting some kind of a stimulus coming in. But unlike that, we have seen for India, I think there is no sign of a stimulus. I think nothing was announced in the budget. In fact, it was definitely signs of a rollback over the limited amount of stimulus that was given through the budget in fiscal 21. So in 22, we're not seeing any signs of that. Because it was probably assumed that the virus was behind us and the vaccination drive was going to begin. So probably that's why we haven't looked at it. But it doesn't seem as if there have been any signals which have been sent out either by the state governments or the central government that if things are going to deteriorate further and we're forced to have lockdowns in more states, there is going to be some support provided by the state. That's definitely not there in India, whereas we can expect that in the Western countries. So therefore, I think the prospects of global growth seem to be more stable than the prospects of India's growth, which at 10.5, we have a number of 10.7%. So there's definitely a downside risk for India, which I can say will probably not hold for the developed countries.
Right. So from your side, what would your projections be for FY22 in terms of GDP and as well as inflation? Do we see any changes happening on that front, taking the latest RBI policy and their statement into consideration?
Yeah, as of now, we are looking at a GDP growth of 10.7 to 10.9%. Okay, that is, we have already factored in the 1 month lockdown in Maharashtra and what the impact would be. But we also agree that even on 30th of April or on 1st May, as and when they decide, let's assume there is some progress made in terms of the virus, the lockdown is not going to be unlocked immediately. It's going to be done in a very gradual manner. And the same thing holds in other states too. So definitely there is a downside risk. When I'm talking of 10.7, there could be another deterioration of 0.5% depending on the intensity of the lockdowns or how long this particular thing remains. And in terms of inflation, I think we still believe India is a country which will always have an inflation of about 5%. In fact, I've always been arguing saying that the MPC should be looking at a band of 5% plus something and not 4%, but they have chosen 4%. So I think we will be in the region of around 5.5% CPI inflation for the year, and WPI inflation probably between 4.5 to 5%.
Okay. And another highlight, Madan, from the policy yesterday was the announcement of the secondary market GSEC acquisition program, or the way they call it GSAP 1.0. What do you make of this program and how is it going to really impact the bond market, the debt market, and the currency overall, according to you?
Actually, when you take this GSAP, it's nothing else but an open market operation. It's in an OMO, you're buying securities in a market. The only thing is that the quantities could be limited. Normally it's 10,000 crores. You could also be having a case of, at times it's also 20,000 crores. But generally what we're talking of OMOs is it's done based on what market conditions are. So at a particular point of time, if the RBI feels there's something amiss with the yield curve, or you're saying that the yields are going up, never probably down, then there is some kind of an intervention in terms of buying specific securities in order to even out the yield curve to generally make sure that the yields are moving in the downward direction. Now, how is the GSAP different? It's also secondary market operation. Even the open market operations are secondary market operations. Only here there's a very big announcement effect. When I talk of an announcement effect, you're saying very clearly that there is going to be 1 lakh crores, which is going to be of paper, which is going to be bought up. So you're telling the banks, you're signaling to the markets that there's a lot of support which is going to be provided in terms of provision of liquidity, so that banks don't have any kind of a handicap when it comes to providing the so-called supply side to, the demands to the supply of government paper, which is going to come in both from the center as well as the states. And given the fact that this year we're expecting economic growth to take off, there will be an increase in private demand for credit. Bank credit has been fairly lackluster last year, except from the retail segment. Let's assume that this year, even the manufacturing sector sees some kind of a demand for credit. Then definitely there could be some kind of squeeze on liquidity. So I think what the GSAP does is that you're making sure that such kind of liquidity is provided, and that ensures that there is order in the market and that the market yields don't come down. How does it affect the rest of the market? The thing is that we should know that if I look at the bond market, for example, all the bond market yields are normally benchmarked with the GSEC yields. So if the GSEC yields remain orderly, or let's assume that they move down because of the quantum of funds which are being provided by the RBI, then there would be a tendency for the cost of borrowing even for the corporates to come down in the bond market. So we see this transmission happening simultaneously, first in the banking system itself, and as well as in the corporate bond market. So on the whole, this provision of liquidity, this dovish stance which has been taken by the RBI, also signals to the market that there will be plenty of liquidity out here. Now, will this actually lead to some impact on the currencies? Yesterday, we got an impression that probably the way in which the rupee depreciated could have been because of the pandemic or the virus effect. But definitely, I think this kind of a stance, a liberal policy taken by the RBI, could have also had some kind of impact on the currency. But we'll have to wait and see in the next few days, next few sessions, whether the rupee continues to move downwards or whether there is stability which comes back. But that's something which has to be watched out for sure.
Right. So overall from all this, could we say that, the short-term yields is something that could rise marginally because of the long tenor variable rate reverse repo auctions? And secondly, we're still expecting that range-bound move in terms of long-term. And lastly, if you see in terms of the Indian rupee as well, can we expect some bit of pressure to continue on the Indian rupee from here on?
In terms of the short-term yields, yes, definitely. I think with the variable, what you call reverse repo coming in of different maturities, longer maturities, the 3.35 will definitely move slightly upwards, which will get reflected in the other maturities. So here we have a situation where the short-term mature levels would be going up. And in terms of the long-term durations, would actually be moving downwards because I assume most of the OMOs which will be conducted will be for the longer term maturities. So that's something which we will definitely see happening. So there will be a kind of shortening of the spread between the long term and the short term yields. Now, in terms of the currency, I think it's going to be driven more by the fundamentals as long as we see very good FPI flows coming in. And I think for what the government announced, FDI has been very buoyant until January. We assume that this will carry on even till March and probably also in the current financial year. I think the fundamentals should provide support to the rupee depreciation. So I think what we saw yesterday or what we could be seeing in the next couple of days would be more transient in nature, but as long as the fundamentals are strong. So the fundamentals means my current account balance has to be strong, my capital account has to be strong. Now we already know FPI and FDI is strong. The current account surplus, which was there in fiscal 21, will definitely turn to a deficit in 22, but it may not be something very significant. Maybe 1.5% of GDP is what we're looking at. Could be the worst case scenario of current account deficit. So the rupee should by and large be depreciating at a very gradual level. In fact, there could be a strong case. I think the stronger case would be because of the dollar getting stronger that the rupee is going to weaken. The external factor is going to play a greater role than the fundamentals. And the RBI could be probably quite happy seeing the rupee going towards 74, 74.5 during the course of the year because that would provide a boost to it.
Right. So taking all our conversation into consideration, anything else that could be a major highlight of the policy that one should be watching out for from the market's perspective overall?
I think the market will get a signal that one, that definitely a rate hike is rolled out, even in case inflation moves upwards. And normally in the months of October, November, we have seen the onion crisis and food inflation going up and overall headline inflation going up. But that probably is not going to come in the way of RBI looking at the repo because the RBI will have to be convinced more on the growth side. I think that's a positive sign. Second, even in terms of GSEC yields, so even though the measures have been overtly treated as being those which are to reduce volatility in the market, but the market is going to believe that the GSEC rates are going to remain where they are. Maybe this minor variation by maybe 6.10 becomes 6.05 or 6.15. But because I remember a couple of months back, just after the budget was announced, we felt that there was potential for a 10-year yield to go towards 6.5, 6.75. But that's probably something which is ruled out based on these policies which have been announced by the RBI. And the RBI has also indicated that things like this GSAP will probably continue even in the second and third quarters. So there will be stability in terms of GSEC yields, which also means that corporate bond market would also be seeing fairly stable costs as far as companies are concerned.
Absolutely. Thank you, Madan, so much for giving us this candid conversation and a view of how we could be looking at the economy from here on as well. Always a pleasure speaking to you. Hope you enjoyed the conversation as well and stay safe.